I'm Michelle Smart. I'm an enrolled agent, and I want to talk to you about is the problem that we have now when people want to downsize who have owned their home for a very long period of time. And as you know, there is an exclusion for the gains on personal property of your primary residence. So if your primary residence is now worth $1 million more than it was when you purchased it, or your basis is exceeded in by $1 million when it's sold, then you would be subject to capital gains tax. So the exclusion is $250,000 if you're single, and the exclusion is $500,000 if you're married. So in other words, if you sell your property and the basis in that property was $200,000 and you sell it for $1 million, you have $800,000 of a gain. However, if you're married, 500 of that is excluded. And so now you have $300,000 of capital gains. And the same on single. So if you were single, if you sold a property that had a basis of $200,000 and you sold it for $1 million, and then you have an $800,000 gain, then 250,000 of that would be exempt from capital gains. Now, there are a lot of very detailed rules about this, so just don't jump into it. You need to talk to a tax professional. When we say you have to have lived in that residence for 2 out of the last 5 years, it's very specific as to what those dates are and so forth. So it's important that you go through the worksheets. If you go to irs.gov and you look up publication 523, you can see the worksheets. I would suggest you work with a trusted tax professional if you're planning on selling your house that has gains that exceed those exclusions. But also, in any rate, you should talk with the tax professional just because the rules are very, very specific. So what can we do if we're selling something that is subject to capital gains? And that happens often if you've lived in your house for a long period of time and you're wanting to downsize. And now you suddenly have something like $400,000 of income or that is subject to capital gains, or $1 million worth of income subject to capital gains, and you're just a retired person living on Social Security. This becomes a problem because you have a huge tax bill. So who wants to sell something, get $1 million, and you're trying to buy something cheaper, but you got to pay all of these taxes. So what can be done? So what we do is we work with trusted tax professionals, partners who are licensed and been in business for a long time. And what we do is we have this program where you, as the person who needs to have reduction in that capital gains or the income subject to capital gains, we work with you to purchase some equipment that's in high demand to be rented. And we work with another company that rents out equipment. So, you go down and you see all these people who are buying all these big trucks and they're using them for construction. We work with someone who needs to rent those trucks, needs more equipment, and there are many options. However, we're going to try to fall into just getting enough of a loss so that your income that is subject to capital gains is going to be erased. Let's say that you have $400,000 worth of gain that's subject to capital gains tax, and we want to erase that. So we want $400,000 worth of deductions. So working in partnership with someone, and I would always say, due diligence, work with your trusted professionals. We would hook you up with those trusted partners. You would purchase a piece of equipment that's in high demand, and say you put $100,000 down on a piece of equipment that's worth $500,000. And with bonus depreciation, and again, we have to check the rules on depreciation every year. You can't take 179 expense to put yourself into a loss. Bonus depreciation, yes, you can put yourself into a loss. So it's very specific how this is done. So those laws change every year as far as bonus depreciation goes. But what we're looking for is to erase $400,000 worth of income that is subject to capital gains tax. So this way, if we had $400,000 worth of bonus depreciation in the very first year of the purchase of this equipment, you would have erased out that income subject to capital gains tax. So the first year you depreciate it, but what you're doing is you own the piece of equipment. The partner is the company that is renting it. So you have a rental business in your newly formed LLC, and you rent the equipment essentially to another company that rents out the equipment. So they do all the management, they hang on to the property, they maintain it, and so forth. They take some fee for that. And then so you're financing that and maybe making a payment. So the idea is that the monthly payment when you finance this is somewhat equal to the rental income that you have, so that we're striving to have a wash there, so that there's no loss, there's no additional income. However, if you had a $400,000 say tax bill, and instead of giving it to the IRS, you put it into annuities, and you just took 100,000 and put it down on this piece of equipment and finance the rest, you're positive. You're in a much better position anyway, and you also have uh, something to fall back on. Let's say it didn't work out or something, that you still have money in the bank that you can use. So the idea is that you use the bonus depreciation to create a loss in your LLC, and this wipes out the capital gains. Now, one of the issues that also I wanted to bring up when you're trying to downsize, if you sell your property with this huge capital gains, now your AGI goes way up and all of your rates go up. And what people don't stop and realize is how far that goes. A lot of people don't realize that the Medicare that you're paying every month that comes out of your Social Security check, it's around $165 a month right now. If you get into income as a single person of, I think it's $103,000, then that goes up an additional $559 per month. So you can be ending up with nearly $700 coming out of your Social Security check just because you had one high year of income. So there are other places that you are affected that you may not realize. So it's really important that you strategically go through everything with a tax professional, with someone who can help you understand what the effect of the sale of a property is going to be, making sure that you know what the depreciation rules are for that year and so forth. So I expect everyone to do their complete due diligence with whatever partners they work with in order to make this work for you, so that you can sell your house, you can downsize without being subject to a huge tax bill. I'm Michelle Smart. I'm an enrolled agent. Thanks for watching. Please like and leave me any questions.